A letter arrived in April. Karen was 67 years old. She lived outside Columbus, Ohio. She had spent the last 3 weeks handling paperwork, the death certificate, the bank accounts, the calls to Social Security. Her husband of 41 years had passed in March, and she had done everything right. She called the financial advisor. She left the accounts alone. She waited. Then the letter came. It wasn't from a collection agency. It wasn't an error. It was a notice from the IRS explaining that Karen owed $14,000 more in federal taxes than she had paid the previous year. $14,000. She hadn't sold anything. She hadn't touched a single account. She hadn't made one financial decision since her husband died. The IRS didn't care. What happened to Karen is not an edge case. It happens to hundreds of thousands of surviving spouses every single year. In Ohio, in Texas, in Florida, in every state in the country. And in almost every case, the family could have prevented it. Not by finding a loophole, not by hiding money, by making 4 specific moves before the first spouse died. Moves that were completely legal, completely available, and completely ignored. Because nobody told them the window would close. Today I'm going to show you exactly what those 4 assets are, what the IRS does to them the moment one spouse is gone, and the moves you still have time to make. Quick note before we go further. I'm not a lawyer, I'm not a CPA, and nothing in this video is personal financial advice. It's the briefing that helps you walk into that conversation with your advisor already knowing the right questions to ask. If this is the kind of information you need to hear, hit that like button right now. It helps this channel reach the people who need it most. Before we name the 4 assets, I need to show you the environment your surviving spouse is about to step into, because without this, the rest of the video won't make sense. When your spouse dies, your tax situation doesn't just change, it collapses. Not because your income dropped, not because you did anything wrong, because of 4 automatic simultaneous changes that the IRS makes to your filing status the moment you go from married to widowed. And when those 4 things happen at the same time, which they always do, yet the math is brutal. Here's the first one. Right now, if you're 65 or older and you file married filing jointly, your standard deduction is $35,500. That's the amount of income the IRS lets you shield before taxation even begins. The year your spouse dies, that number drops, not gradually, immediately. Your new standard deduction as a single filer over 65 is $18,150. You just lost $17,350 in protected income without touching a single account, making a single trade, or earning a single extra dollar. The second hit happens in your tax brackets. Right now, the 22% federal bracket doesn't kick in until your taxable income passes $105,700 as a married couple. As a single filer, that same 22% bracket starts at $50,400. Same bracket, same rate. But the threshold is cut almost in half. So, if you were sitting comfortably at $80,000 in taxable income as a married couple, you were well inside the 12% bracket. As a single filer, that same $80,000 pushes you into 22%. Your income didn't change. Your bracket did. The third hit is Medicare. Medicare's IRMA. A, surcharges, the income-related monthly adjustment amounts that add hundreds of dollars to your Part B premiums. Don't kick in for married couples until your combined income exceeds $218,000. As a single filer, that same surcharge starts at $109,000. The threshold cuts in half. If your income as a surviving spouse sits anywhere between $109,000 and $218,000, you have just entered Medicare surcharge territory for the first time in your life. We're talking Part B premiums that can run from $284 to nearly $690 a month. And that number adjusts based on your income 2 years prior, so you may not even see it coming until the bill arrives. The fourth hit is your Social Security. The provisional income thresholds that determine how much of your Social Security is taxable have not been updated in decades. They don't adjust for inflation. As a single filer, up to 85% of your Social Security becomes taxable once your provisional income exceeds $34,000. As a married couple, that same 85% threshold sits at $44,000. Your Social Security check didn't shrink, but more of it is now subject to income tax. There is one small grace period the IRS gives you. For up to 2 years after your spouse's death, if you have a dependent child living with you, you may qualify as a surviving spouse and continue to use married filing jointly brackets. Most people in this audience won't qualify for that. Their children are grown. So the full penalty lands in year 1. Your income didn't change, your bills didn't change, but your tax bill just grew automatically by law because of one change in your filing status. That is the widow's penalty. And every single asset we're about to discuss gets dropped into that environment the moment the first spouse dies. The IRS built a second clock on top of this one, and it started ticking the day your spouse passed. That's what we're talking about for the rest of this video. Let's start with asset number 4. Asset number 4, the taxable brokerage account. Most people assume that when a spouse dies, the investment accounts transfer cleanly. The survivor gets the accounts, the stocks, the funds, and life goes on. And in one very important sense, that's true. But there's a detail buried inside that transfer that determines whether your children inherit a fortune or a tax bill, and it depends entirely on which state you live in. Here's the concept you need to understand: cost basis. When you buy a stock, a mutual fund, or any investment, the price you paid for it becomes your cost basis. That's the number the IRS uses to calculate your gain when you eventually sell. If you bought a stock for $10 and sold it for $40, your gain is $30, and that $30 is subject to capital gains tax. Simple enough. Now here's what happens at death under a rule called IRC Section 1014. When someone dies, the cost basis of their investment assets resets to the fair market value on the date of death. The IRS calls this a step-up in basis. What it means in plain terms is that any gain that built up during the deceased person's lifetime, so sometimes over decades, simply disappears for tax purposes. If your husband bought Microsoft in 1995 for $3 a share and it's worth $400 today and he dies today, the new cost basis for that stock becomes $400. Your children could sell it the next morning and owe zero capital gains tax on 25 years of growth. That is an extraordinarily valuable benefit. And most married couples assume both spouses get it. Here's where it gets complicated. Whether you get a full step-up on both halves of your joint assets or only a partial step-up depends on one thing: the state you live in. 9 states in this country are community property states: Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, Wisconsin. In those states, assets acquired during a marriage are considered jointly owned by both spouses, 50-50, by law. And when one spouse dies, both halves of those jointly owned assets receive a step-up in basis. The entire position resets to the current market value. Both halves. The surviving spouse could sell everything the next day and owe nothing on decades of growth. The other 41 states operate under what's called common law. And in common law states, only the deceased spouse's half of a jointly held investment account receives the step-up. The surviving spouse's original half and the half they contributed, the half that's been sitting there since 2004 or 1998 or 1989, keeps its old cost basis, the low one, the one from when the investment was first purchased. Let me make this concrete. Say you and your husband live in Florida. Back in 2004, you opened a joint brokerage account together and bought shares of a broad index fund. You each put in $50,000. Today the account is worth $400,000, $200,000 attributed to each of your halves. Your husband passes away. His half steps up to the current value. That $150,000 of gain on his side disappears. But your half, your original $50,000 contribution, still carries a 2004 cost basis. When you eventually sell your half, you owe capital gains tax on $150,000 of growth. The government didn't give you a step up. Your husband's half got one, yours didn't. Drop your state in the comments right now, as community property or common law, and I'll tell you exactly which category you're in. This one detail changes the math considerably. Now, for some people watching in Florida, Alaska, Kentucky, South Dakota, or Tennessee, there is actually a legal option worth asking your estate attorney about. These 5 states allow married couples to opt into something called a community property trust. If you retitle your jointly held assets into this trust structure before the first death, both halves of those assets can qualify for the full step-up, the same benefit that California and Texas residents get automatically. It requires legal setup. It requires planning. But for a couple sitting on a large taxable brokerage account with a low-cost basis, it can be worth tens of thousands of dollars in future capital gains tax that simply never gets paid. This is the 4th asset on our list, and honestly, for most couples, it's the most manageable one. The step-up benefit is real, the partial protection is real, and the solutions exist. But I put it at number 4 because what comes next is harder to escape. There is one specific type of account in America that was written into the tax code specifically to never receive a step-up in basis. Not a partial one, not a reduced one, none. Your children will inherit that account and pay ordinary income tax on every dollar of growth, no matter how long you held it, no matter what the market did, no matter what state you live in. That's asset number 3. And we're going to it right now. Asset number 3. The non-qualified annuity. There is a rule in the American tax code that most annuity owners have never been told. It was not designed to hurt you. It was not designed as a trap. But for families who discover it after the first spouse dies, it functions like one. Here it is. Annuities, specifically non-qualified annuities, the kind held outside of an IRA or 401k, do not receive a step-up in basis at death. Ever. Not a partial one. Not a reduced one. None. When you die and your children inherit your annuity, they inherit the full accumulated growth inside it, and every dollar of that growth is taxed as ordinary income. Not capital gains, not at a preferred rate. Ordinary income at whatever federal bracket they happen to be in the year they take it out. Let me explain what makes this different from everything else we've discussed. With a brokerage account in a common law state, you at least get a partial step-up. The deceased spouse's half resets. There's some relief. With an annuity, there is no relief. The tax code is explicit. The step-up in basis under IRC section 1014 does not apply to annuities. Congress carved them out. The logic was that annuities already receive tax-deferred growth during the owner's lifetime. That deferral was the benefit, and the IRS intends to collect on every dollar of growth eventually, regardless of who ends up holding the account. For a non-qualified annuity, here's how the math works at death. Say you purchased a non-qualified annuity 20 years ago with $150,000 of after-tax money. That $150,000 is your premium, your cost basis. It comes back to your heirs tax-free because you already paid tax on it before you put it in. But the growth, everything above $150,000, is a different story. If the account has grown to $400,000, your heirs have $250,000 of taxable gain sitting inside that contract. And all of it comes out as ordinary income. For a child in their 50s already earning a salary, the $250,000 of forced ordinary income could push them into the 32% or 37% federal bracket, depending on how it's distributed and what else they have coming in. Add state income tax on top of that in most states, and the real-world loss on that gain portion can approach half of what accumulated. Not because the IRS designed it as a punishment, because the math, applied honestly, works out that way. Now here's the part that most surviving spouses don't know, and it's the most important sentence in this entire section. If you are the surviving spouse, you have an option that your children do not. It's called spousal continuation. Instead of inheriting the annuity as a lump sum, which would trigger ordinary income tax on all of that gain immediately, a surviving spouse can step directly into the owner's shoes. You assume the contract. You become the new owner. The tax-deferred status of the annuity stays intact. No taxable event, no forced distribution. You continue letting the money grow inside the contract, on the same terms until you decide what to do with it. Your children cannot do this. A non-spouse beneficiary inherits the annuity and faces a distribution, either as a lump sum or over a period defined by the contract. And the gain portion is taxable as ordinary income on whatever schedule they take it. The spousal continuation option is exclusively for a surviving spouse, and it must be elected. It is not automatic in every contract. It requires knowing it exists and asking for it. If you or your spouse owns a non-qualified annuity with significant growth, that conversation needs to happen now, while both of you are alive, so the surviving spouse knows exactly what to do and how to do it before any distribution is triggered. A single phone call to the annuity company made in the wrong direction after a death can create a taxable event that cannot be undone. One more thing before we move on. If your annuity is held inside an IRA, what's sometimes called a qualified annuity, the rules are different. In that case, the entire account is subject to IRA rules at death. And we're going to cover those in detail right now, because the traditional IRA and 401ks is the asset that affects the most people in this audience, holds the most money, and carries the largest tax exposure of anything on this list. This is asset number 2. And the IRS built an entire 10-year clock specifically for your children. Asset number 2, the traditional IRA and 401k. I want you to think about a number for a moment. $500,000. For a lot of couples in this audience, that's roughly what sits inside a traditional IRA or 401k, sometimes more, sometimes less, but it's in that range. It's the account you've been building for 30 or 40 years. The one with the tax deduction on the way in, the tax-deferred growth in the middle, and the promise that you'd pay the taxes eventually in retirement when your income would be lower. That was the plan. Here's what the IRS has planned for your children. Before 2020, when a non-spouse beneficiary inherited a traditional IRA, they had what was called the stretch IRA. They could take distributions from that account over their own life expectancy, sometimes 30, 40 years, paying a manageable amount of tax each year as they went. It wasn't perfect, but it was survivable. A $500,000 IRA spread over 35 years is a very different tax problem than a $500,000 IRA compressed into 10. The Secure Act changed everything. Effective for deaths after December 31st, 2019, non-spouse beneficiaries, your adult children in most cases, no longer have the lifetime stretch. They have 10 years. The entire account must be fully distributed by December 31st of the 10th year following the year of death. No extensions, no exceptions for most beneficiaries. 10 years, and then it's done. Now here's a detail the IRS clarified in its final regulations issued in July of 2024 that caught a lot of people off guard. If the original IRA owner died on or after their required beginning date, the age at which they were required to start taking minimum distributions, which is now 73 for people born between 1951 and 1959, and 75 for people born in 1960 or later. Then the beneficiaries must also take annual distributions in years 1 through 9, in addition to fully emptying the account by year 10. They don't just have a 10-year window to do whatever they want. They have required annual withdrawals throughout that window. If the owner died before the required beginning date, the annual RMDs in years 1 through 9 are not required. The heirs just need to empty the account by year 10, on whatever schedule works for them. The distinction matters, but either way, the core problem is the same. Every dollar that comes out of an inherited traditional IRA or 401k is taxed as ordinary income, not capital gains, not at a preferred rate. Ordinary income, stacked directly on top of whatever your child is already earning that year. Let's walk the math on that $500,000. Your daughter is 52 years old, she's a teacher, she earns $65,000 a year. She inherits your $500,000 IRA. If she spreads it evenly, $50,000 per year over 10 years, that $50,000 in IRA distributions gets added to her $65,000 salary. Her total taxable income is now $115,000. At that level, she's inside the 22% federal bracket, pushing toward the 24% bracket depending on her deductions. That's manageable, but not comfortable. Now suppose she has a good year at work, a bonus. Maybe her spouse also earns income. That same $50,000 distribution could push the household into the 32% bracket. And if she ever takes a larger distribution, say she needs $100,000 in 1 year for a home repair or her own retirement, the bracket exposure gets worse, not better. And that's before state income tax. Most states tax IRA distributions as ordinary income. In California, that could add another 9.3% on top of the federal rate. In New York, another 6.85%. The combined federal and state tax hit on a large inherited IRA distributed over 10 years by someone who's still working can easily approach 40 to 45 cents on every dollar. For heirs in high-income states, at peak earning years, it can go higher. This is where the title of this video comes from. The old penalty for missing a required minimum distribution was 50%. The IRS took half of whatever you failed to withdraw as an excise tax on top of the income tax you still owed. Congress reduced that penalty to 25% in 2023 under Secure 2.0. And if you correct the mistake within 2 years, it drops further to 10%. That's an improvement. But here's the honest math. When you add up the federal income tax, the state income tax, and the bracket compression that happens when $50,000 of forced ordinary income lands on top of an existing salary, year after year for 10 years, the real-world loss to taxes across that full window can approach 50 cents on every dollar in your account. The number in the title isn't a historical footnote. It's what actually happens to the money, applied honestly for heirs in the wrong tax situation. Now here's the part that changes everything. And I'm going to say this as clearly as I can. Your surviving spouse is not subject to the 10-year rule. A surviving spouse who inherits a traditional IRA has an option that no other beneficiary in the tax code has. They can roll the inherited IRA directly into their own IRA, a trustee-to-trustee transfer, and treat it as their own account. When they do that, the 10-year clock disappears. The account is now subject to the surviving spouse's own required minimum distribution schedule based on their own age. If they're 67 and their required beginning date isn't until age 73, they just bought 6 more years of tax-deferred growth on an account the IRS was ready to compress into a decade. That is the most powerful single move in this entire video. But, and this is the part that matters, it can only be initiated after the first spouse dies. The surviving spouse has to know it exists, know how to do it, and act before any distribution is accidentally triggered. A surviving spouse who takes a distribution from an inherited IRA before completing the rollover may not be able to undo it. The move is available. The window is real. But it requires knowing what to do before the paperwork starts. And there is one thing a surviving spouse cannot do that we need to be completely clear about. A non-spouse beneficiary, your adult child, cannot convert an inherited traditional IRA into a Roth IRA. Only the surviving spouse has that ability, because only the surviving spouse can treat the inherited IRA as their own. Once your child inherits it, the 10-year ordinary income clock is running, and there is no Roth conversion available to stop it. Which is exactly why the most important move in this video has to happen now, while both spouses are alive, before the clock starts. I'm saving that move for the action section because it's the one that addresses not just the IRA, but every asset on this list simultaneously. But before we get there, I need to show you the fourth asset, and unlike everything else we've talked about today, this one isn't an account. You can't roll it over. You can't transfer it to a trust. You can't convert it to a Roth. You can only use it while you still have it, and the moment the first spouse dies, it's gone. Asset number one, the tax status you're about to lose. I want to reframe something before we go further. Everything we've talked about so far, the brokerage account, the annuity, the IRA, those are things you can see on a statement. You can log in and check the balance. You can call the custodian. They feel like assets because they look like assets. What I'm about to describe doesn't appear on any statement. No custodian holds it, no beneficiary form controls it, but for most married couples in this audience, it is worth more in real annual spendable dollars than any single account they own. It's called married filing jointly. Right now, if you are married, the IRS grants you and your spouse a combined tax structure that took decades to build. 2 Social Security incomes, 2 sets of deductions, 2 bracket thresholds, a standard deduction of $35,500 if you're both over 65, a 22% bracket that doesn't kick in until your taxable income passes $105,700. IRMA surcharges that don't start until your combined income exceeds $218,000. Social Security that stays in lower brackets because the thresholds are wider. That entire structure, built over a lifetime of working, saving, and filing together, is a tax asset. And most couples have never once thought about it that way because it has always just been there. The day the first spouse dies, it's gone. Not reduced. Not adjusted. Gone. The surviving spouse files as single. The standard deduction drops to $18,150. The 22% bracket starts at $50,400. The IRMAA threshold falls to $109,000. The Social Security provisional income math stays exactly the same, but the brackets it feeds into are now compressed. Everything costs more. Every dollar of income is taxed harder. And unlike the IRA, you cannot roll this over. Unlike the annuity, there is no spousal continuation option. Unlike the brokerage account, there is no trust structure that preserves it. There is one grace period, and it is narrow. If you have a qualifying dependent child living in your home in the years following your spouse's death, you may be eligible for qualifying surviving spouse status, which allows you to use married filing jointly brackets for up to 2 years after the death. For most people in this audience whose children are grown and out of the house, that exception does not apply. The full filing status change lands in the year of death, and it lands permanently. Here's the number I want you to sit with. Depending on your income level, the difference between what you owe in federal taxes as a married couple versus what you'll owe as a single filer on the exact same income can range from $5,000 to $30,000 per year, every year, for the rest of the surviving spouse's life. That is not a one-time cost. That is a permanent, annual, compounding tax increase that begins the year your spouse dies and never goes away. Most couples plan for the death of an income. They think about what happens when one Social Security check stops. They think about pension survivor benefits. They think about life insurance. Those are real and important things to plan for. But the death of a tax bracket is something most financial plans never address. And in many cases, the bracket is the one that does more long-term damage than the income loss itself, because it affects every dollar of income you still have for every year you have left. Now, here's the reframe I want you to take into your next conversation with your advisor. The married filing jointly status you currently hold is a perishable asset. It has a value you can calculate. You can run the numbers on what your tax bill looks like today versus what it will look like the year after your spouse dies. That gap, multiplied by the number of years the surviving spouse is likely to live, is the real cost of not acting. It is a large number, and unlike an IRA you can convert or a brokerage account you can retitle, there's no move you can make after the first death to recover it. The moves have to happen now, while both spouses are alive, while the brackets are still wide, the deductions are still doubled, and the window is still open. And that is exactly what we're going to talk about next. The action section, 5 specific moves, mapped to every asset we've covered today. One of them, and the first one, is the single most powerful tax planning tool available to a married couple in this audience, and most people are not using it. If you've gotten this far and you know someone who needs to hear this, this is the moment to share this video with them. What's coming next is the part that actually changes the outcome. Let's go back to Karen, 67 years old, Columbus, Ohio. $14,000 in unexpected taxes the year her husband died. She hadn't sold anything. She hadn't made a single financial move. The bill arrived anyway. Here is what happened specifically. Her husband had a $400,000 traditional IRA he had been contributing to for 30 years. He never converted a dollar of it to Roth. When he died, Karen inherited it and rolled it into her own IRA, which was the right move, and she did it correctly. But the damage wasn't in the IRA. The damage was everywhere else. Her standard deduction dropped by $17,350 the year he died. Her Medicare surcharges appeared for the first time because her income, now measured as a single filer, crossed the $109,000 IRMA threshold. Her Social Security income, unchanged in dollar amount, was now sitting in a compressed bracket. None of it was reversible. None of it was a mistake. It was the system running exactly as designed on a couple who never knew the window existed. Her husband was 71 when he died. His required beginning date for RMDs was age 73. They had 2 years. 2 years when his income was lower, her income was lower, their combined brackets were wide, and the cost of converting that IRA to Roth was as cheap as it was ever going to be. They didn't know, so they didn't act. That window is what the next 5 moves are designed to protect. Move 1. Roth conversions while both spouses are alive. This is the move. If there is one action from this entire video that matters more than any other, it is this one. And the reason is that it is the only move that addresses every asset on today's list simultaneously. Here is what a Roth conversion does. You take a portion of your traditional IRA or 401k, the pre-tax money, and you convert it to a Roth IRA. You pay the income tax on that converted amount now in the current year at your current rate. The money moves into the Roth, where it grows tax-free, requires no lifetime distributions, and when your children eventually inherit it, still subject to the 10-year rule, every distribution they take comes out completely tax-free, as long as the 5-year holding rule has been met. Think about what that does to the math we ran earlier. Your daughter, the teacher, $65,000 salary. Instead of inheriting a $500,000 traditional IRA where every dollar is ordinary income, she inherits a $500,000 Roth IRA. Over 10 years, she takes $50,000 per year. None of it is taxable. None of it pushes her into a higher bracket. None of it triggers IRMAA on her own Medicare. The 10-year rule still applies, she still has to empty it, but the 10-year window becomes a 10-year gift instead of a 10-year tax problem. And while you're alive, the converted balance no longer generates required minimum distributions. A Roth IRA has no lifetime RMD requirement for the owner. Every dollar you convert is one fewer dollar the IRS can force you to take out in a year when you don't need it, and one fewer dollar that counts toward the income thresholds that trigger IRMAA, Social Security taxation, and bracket compression for your surviving spouse. The critical window for this move is while both spouses are alive and still inside the wider married filing jointly brackets. Every year you delay, the brackets get narrower. Every year you delay, the account grows, which means more to convert later at a higher cost. The time to do this is now, in measured annual conversions that fill your current bracket without pushing you into the next one. Your tax advisor can run that number. The concept is simple. Convert up to the top of your current bracket every year for as many years as you have. This is the move Karen's husband didn't make. It is available to you right now. Move 2, the spousal IRA rollover. We covered the mechanics of this in the IRA section, but I want to make sure it lands as an action item. When a spouse dies, the surviving spouse must roll the inherited IRA into their own IRA, not just rename the account, not just leave it as an inherited IRA in their name. A direct trustee-to-trustee transfer into their own IRA account. When done correctly, the 10-year clock disappears. Required minimum distributions are now based on the surviving spouse's own age and their own required beginning date. 73 for those born between 1951 and 1959, 75 for those born in 1960 or later. This move does not require both spouses to be alive to plan for it, but it requires the surviving spouse to know it exists and to act before any accidental distribution is triggered. A surviving spouse who takes even one distribution from an inherited IRA before completing the rollover may find themselves in a more complicated position. The move is straightforward, the paperwork is manageable, but it has to be intentional, and it has to happen in the right order. Make sure your spouse knows this is the first call to make. Move 3, Community Property Trust for Common Law State Residents. If you live in Alaska, Florida, Kentucky, South Dakota, or Tennessee, and you're sitting on a jointly held brokerage account with a low-cost basis, meaning significant unrealized gains built up over years or decades, it is worth having a conversation with an estate attorney about a community property trust. Retitling your jointly held assets into this structure before the first death can potentially qualify both halves of those assets for a full step-up in basis, the same benefit that California and Texas residents receive automatically. It requires legal setup. It requires planning. But for a couple with a large taxable brokerage account and a 1998 cost basis, the capital gains tax that never gets paid can be substantial. If you're already in one of the 9 community property states, you may have this protection in place automatically, but it's worth confirming with your attorney how your assets are titled and whether the full step-up applies to your specific situation. Move 4. Annuity spousal continuation. If you or your spouse owns a non-qualified annuity with significant accumulated growth, the surviving spouse needs to know before the death occurs, before the paperwork begins, that the spousal continuation option exists and must be specifically elected. It is not automatic in every contract. It is not offered proactively by every insurance company. The surviving spouse must call, ask for it by name, and complete the election before any distribution is triggered. Electing spousal continuation allows the surviving spouse to step into the owner's shoes, assuming the contract, maintaining the tax-deferred status, and avoiding the immediate ordinary income tax hit on decades of accumulated gain. It is a one-time decision made in a narrow window after the death. Getting it wrong, taking a lump sum distribution when the continuation option was available, creates a taxable event that cannot be reversed. Make sure both spouses know which annuities exist in the household, who the issuing company is, and what the spousal continuation procedure requires. Move 5. Beneficiary Designation Review. This one takes 30 minutes and costs nothing. Pull every retirement account in your household, every IRA, every 401k, every 403b, and verify the named beneficiary on each one. Here's why this matters more than most people realize. If a retirement account names your estate as beneficiary instead of a living person, the 10-year rule may be replaced by an even shorter 5-year rule, depending on the account type and circumstances. The compressed timeline means larger forced distributions, higher annual income, higher brackets, and more tax. If a retirement account names a trust as beneficiary, the rules governing how that trust is written determine whether the 10-year stretch still applies, and an improperly drafted trust can eliminate it entirely. The fix is simple. Named beneficiaries should be current, living people, primary and contingent, updated after every major life event, divorce, death, remarriage, a child who predeceases you. This is the lowest cost, highest leverage administrative task on this entire list, and surveys consistently show that a significant percentage of retirement accounts have outdated or missing beneficiary designations. 30 minutes. Do it this week. Now let me bring this back to where we started. Karen's $14,000 tax bill was not an audit. It was not a penalty. It was not an error. It was the widow's penalty running exactly as designed, and the standard deduction cut in half, the brackets compressed, the Medicare surcharges triggered, all in the same calendar year with no warning and no way to undo it. Her husband's $400,000 IRA was intact. The spousal rollover was completed correctly. The money was safe. But the window to convert had been open for years. It closed in March. The 4 assets we covered today, your taxable brokerage account, your non-qualified annuity, your traditional IRA and 401k, and your married filing jointly status, are not problems after the first death. They are opportunities before it. The moves exist. The law allows them. The math supports them. What they require is a conversation, a plan, and enough time to act. Before we close, a reminder that nothing in this video is personal tax or legal advice. The rules we've covered today are federal rules, and your state may layer additional taxes on top of them. The numbers here are 2026 federal figures. Your specific situation, your account balances, your income, your state of residence, your ages will determine exactly how much of this applies to you and in what order to act. Bring these questions to a qualified CPA or financial planner who specializes in retirement tax planning. Walk in knowing what to ask. That's what today was for. If this video gave you something you didn't know this morning, the most useful thing you can do right now is share it with a sibling, a spouse, a friend who's been putting off this conversation. The window doesn't announce itself. It just closes. And if you want to go deeper on the Roth conversion math, how much to convert, in which years, at which bracket levels, that is the next video. It is the single most important tool from today's list, and it deserves its own hour. I'll see you there.